So welcome again, everyone. What we're doing today is we're summarizing our finance and operations report for this year, which we will also have a published version of hopefully sooner rather than later if I could stop flying around everywhere. But what we did is we captured data and summarized certain key aspects of it, which I'll go through now with you in some detail. Now, at the top of this list is this concept that's critical, which is the difference between insight and data. And I'm going to take about 3 or 4 minutes to illuminate the importance of that. Very often industry surveys are about gathering data, which are really numbers, maybe ratios, but without context and without insight, it can become dangerous. And so what we try to do with our data gathering, and for those that are familiar with what we do, we're very passionate about not providing numbers back, but we're passionate about providing insight that clubs can use to make actionable decisions. And I think from my perspective, the critical aspect of that, or a critical aspect of that, is the ability to use the insight in the boardroom, because there are too many opinions in the boardroom and there's not enough context, and it really disrupts the dialogue. And the dialogue in the end will, and I'm going to get into some of this in some real detail, but the dialogue in the end will, in the boardroom, will manifest itself in the health of the club over time. There's no question. I'll show that with data shortly. So I'd just like to dig into the difference between insight and data on the front end, and then we'll go through. We can't obviously in 45 to 50 minutes, these are supposed to be quick. We can't go through everything. So what I have done is selected what I think the most important KPIs or key performance indicators are. And we're going to go through those one at a time and take questions and answers as they come. And then we will do a summary and conclusions. So club benchmarking, we've been at this now since 2009, so it's about 8.5 years now. Boy, it went fast. And we continue to learn. We have not stopped. We won't stop. Every day is an experience. I heard one of the best ideas. I've been, on the road, as we all know, a lot, and I've been in front of a lot of boards and committees and clubs. I was at a club in Florida yesterday. I just got off the plane before I had to do the webinar. And I heard one of the best ideas I've heard in the 8.5 years we've been doing this yesterday in a committee meeting, which I love, because you think you've heard it all, but you have never heard it all. So we're very open to and receptive to listening and learning and evolving, which is critical. One of the key pieces that we have learned is we've tried to understand the difference between data and insight. And so I'll use an example. It's a real example that brings this to light. But data by itself, what you're looking at here in this column of numbers, is a cluster of yacht clubs. It's the F&B profit or loss. So it's sorted from greatest loss to greatest profit. So there's a club, I think there's about 30 clubs on the list. One of the clubs had a deficit in F&B of about $564,000 in this current year, the survey year. And another club had a profit of $335,000 in F&B. So if we were to just compare F&B profit or loss, which frankly and unfortunately is done with some regularity across the industry, we might ask the question, hey, which club would we like to be? Now, on the surface, you'd look at it and say, I think it would be better to be the club that has a $335,000 profit than a $564,000 loss. But when you put data, when you surround data with insight and context and knowledge, and we've come to this point only from analyzing and studying the data, what we find is the club that had the high loss has a $37,500 initiation fee, and the club that had the highest profit had a $1,000 initiation fee. I say had because they've changed it recently. They've been using the data to make actionable decisions, and recently they've increased their initiation fee. Kudos to them. They've tripled it. What we'll see shortly is one of the critical key performance indicators is net available capital ratio, which is the capital generation in relation to the operating revenue, which normalizes all clubs. We believe a club at a minimum needs to generate between 12 and 15% of its operating revenue year in and year out in net available capital, which is also the same as earnings before depreciation, in order to maintain itself consistently over time. So the club with the greatest deficit in F&B had a 22% net available capital ratio, which puts it well into the upper quartile of the industry. And the club with the profit in F&B had a net available capital ratio of 5%, which is probably not reflective of a sustainable market position, and is well into the lower quartile of the industry. And then when you look at the membership churn, we measure how many full members downgrade or exit every year as a percentage of the year-ending full member count. And we can see the club with the food and beverage deficit had a very normal, this is the industry norm, 5% churn, whereas the other club had a 20% churn. That should say actually recently well over 30%. It's gone down recently because of some of the decisions they've made at that club. But 5% churn means you have to replace your full membership every 20 years or once a generation. 20% churn needs to replace your members every 5 years. Completely different issues or challenges.
Ray,
we
have a question as to how you calculate full member turnover.
Yeah, so we take in a given year, we take the total number of full members who either left the club or downgraded to a lower category, that total, and we divide it by the number of full members at that year end. And the industry median hovers between 5 and 6%, which is pretty rational. It's basically, as I said earlier, it's churning. The club's full membership is going to churn over the course of a 20-year period or a generation. So what we found with context and insight here is that those numbers standing alone could be dangerous. We know that food and beverage is an amenity in a club, no different than any other amenity. And I know we harp on this, but it's so important. We can't stop. And if we were to just look at the F&B profit or loss in an isolated way, just looking at numbers of data, we would be in real trouble because we would have made poor decisions. But when you look at it with other information, other data and context and insight layered around it, based on experience, based on analysis, based on study, you have a completely different story. And that's a critical point. So we aren't doing surveys, and thankfully we still, 1,000 clubs have participated the last several years in what we gather every year. We're not doing it to provide data to our customers and constituents. We're doing it to provide insight that can drive actionable decisions that can have an impact on the sustainability of a club. And I'm getting a little older since we started the company. I'm probably become a little more jaundiced. Right at this point, I'm on the road and in front of 3 or so boards a week. Used to be I'd never do one in November. I'm probably gonna do 15 this month alone before Thanksgiving. And every time I'm in front of one now, I just see the patterns are becoming so distinct, so clear, where the dialogue is in the boardroom, where it needs to be, and how impactful insight can be in that dialogue. And by the way, it's also very clear how clubs success or lack thereof over time is directly related to the dialogue that occurs in the boardroom. We have three legs of a stool that kind of bring this whole thing together, I believe. And that's our financial insight model, the key performance indicators, there's 17 at this point, that are related to the financial insight model after we've studied it for a period of time. And then the concept of fact-based governance. There's so many clubs, so many boards, and a certain number of people on the boards, or even in the membership for that matter, who act purely out of emotion with no information whatsoever. And it subjects the club to the likelihood of poor decisions as a result that have a profound impact on the outcome. And so we're so passionate about the fact that this can be changed completely if we open our minds to the information and insight and data that exists. And at the core of that, in a club, where things get confused, as people come into the boardroom, we've kind of all been trained in our business backgrounds that profit is good and loss is bad, that every department needs to make a profit, that there's a right way and a wrong way. I'll use cost maintenance expense or spending as an example, that there's a right amount to spend maintaining a golf course given a certain criteria or a certain set of characteristics like number of holes or the square foot of greens, etc. We're so convinced there's a right way and a wrong way, or a right number and a wrong number. And the insight and the information that we've gleaned out of all this work is so clear that that is not the case, that clubs make choices. It's not about right or wrong. It's not about profit or loss. It's about the choices that are made. In understanding those choices and understanding how those choices impact the outcome. I'm fond of talking about a club I've run into where in this survey year, that club has 600 full members, really 600, they're all full, there's only one category. And last year that club, folks on the webinar may have heard me say this, that club gave away $116,000 in free candy. Now, if profit is good and loss is bad, that would be quote unquote a bad thing, but it's not a bad thing. They have very satisfied and loyal members. The club does very well financially, and it's a choice that they make. It's a choice that they make, and they have absolutely every right to make in their club. Of course, it's going to come back to them in dues, how much they pay to belong to the club, but that's a choice they get to make. No different than in the 18-hole golf clubs in our database, that the spending for 18 holes varies from about $300,000 a year to over $3 million. And if you look at the physical characteristics of the club spending $300,000, and you compare them to the club spending over $3 million, they're almost identical in terms of acres maintained, square footage of greens, number of bunkers, etc. So that's a choice as well. One club has the ability to afford spending $3 million, and the choice is that the members pay a lot in dues in order to do that, and they enjoy it. And the other club has to make a different choice because they can't afford to spend $3 million. They can only afford to spend $300,000. So there's no right or wrong there, but that data helps understand why it's happening. And as long as we're stuck in the, I'll call it the old way of looking at things, that it's about efficiency, it's about profit, it's about the right number. As long as we're stuck in that mode, we probably are not managing and governing from the perspective of the way the industry really works. So if you're involved in a survey to get data, it can be dangerous. Don't ever compare raw numbers with peer clubs, please. I beg everyone. It has to have context. If it doesn't have that context, if it doesn't have that insight, it's trouble. But if it does have that insight, and if it does have that context, it can be very powerful. And so what we've done in this year and prior years is we're trying to deliver that critical insight resulting from our study of over 1,000 clubs over the last 9 years. So with that, let's move into some of the KPIs. Here's the ones that we are going to take a look at today. And as I said earlier, you know, we're very passionate. I think everyone knows that about this, and we're learning every day. I would say that with all the study and analysis we've done in the last 8 years, the most meaningful, the most important insight that we've garnered has come in the last 6 months. We, like the industry, when we started the company, we focused very heavily on the operating ledger, and we focused on it for the last 7 years. And over the course of the last year, through a series of, frankly, it relates directly to travel. If we weren't out traveling and we weren't out visiting clubs constantly, we probably wouldn't have come upon it. But as a result of visiting clubs, one specific case led us to start investigating the balance sheet. And now, over the last 6 months, that's where most of our new insight has been derived. And it's so important. In fact, it's more important than the operating ledger. There's no question. The estimate that we have based on asking board members and managers over the last 6 months, where do you put your time in the budgeting season? Where do you put your time in the boardroom, in the finance committee room? And inevitably the answer is someplace between 80 and 90% on the operating or income statement, operating ledger income statement, and 10 to 20% on the balance sheet or capital ledger. It's completely backwards. We have to change that. Success is on the balance sheet. The difference between thriving and dying is on the balance sheet. It's not the operating ledger. The operating ledger is important. I'm not trying to say it's not. I'm just trying to say the balance sheet's more important, and the industry is completely upside down in terms of this. So we're going to look at 4 balance sheet KPIs that we've come to understand through our analysis in the last several months. We're going to look at the bridge, a metric that bridges the balance sheet and the income statement, which I've highlighted in green there, the net available capital ratio. And then we'll look at a small selection of KPIs from the operating ledger. So there's 9 KPIs here. Out of, I said 17, if you count the balance sheet metrics, we're up to about 23. So it's 9 of 23 KPIs. I have actually listed them from my perspective in order of importance. So I think the most important of these 9 is at the top, and the least important is at the bottom. Unfortunately, in too many boardrooms, the least important, or number 9 one, is the one discussed all the time, and number 1 is never discussed. So we'll look into that here shortly. All of this emanates from our financial insight model, which is purely a standard way of looking at not necessarily the accounting, but the financial aspect of clubs. There's a big difference between finance and accounting. Strategic management revolves around the financial view, not an accounting view. And this is a financial model for private clubs. We have an operating ledger and a capital ledger and semi-private clubs. They intersect at that with the operating result. Clubs that generate an operating deficit consume capital to fund it, and clubs that generate an operating surplus generate excess capital that can be used on the capital ledger. And the ultimate bottom line is what we call net available capital, which is ultimately earnings before depreciation, but after covering interest on debt. And it's the most critical, it's the bridge. As we said, it's the bridge between the income statements, both operating and capital, and the balance sheet. It's the amount of money that the club has at the end of the year to make capital investment, pay down debt, or put money in the bank. You can do one of those 3 things or all 3 of those things with that pile of money. And we'll get into that in detail here in a minute. So most not-for-profit member-owned clubs refer to what we'll call net worth for the moment. Net worth is a measure of any business, whether it's a not-for-profit business or a for-profit business. There's a balance sheet. Every business must have a balance sheet. The balance sheet shows where the money came from on one side, the liabilities and equity side, and it shows where it went on the other side, the asset side. So the asset side of the balance sheet is what we have. It's what the club has, the actual assets the club has and owns. And the liabilities and equity side reflects where that money came from. In clubs, there's basically two sources. Our money, meaning the members' money, and someone else's money, typically a bank, meaning liabilities. So the money flows to assets. In the section on equity, in a not-for-profit member-owned club, the book value, the net worth of the club is reflected as unrestricted net assets is typically used. It could also be called members' equity, might be called owner's equity or stockholders' equity, but it is the equity, the net worth, the book value of any business, but in this case, clubs. This shows a distribution. We've gathered balance sheet data from well over 100 clubs. So we're behind on the balance sheet gathering because, as I said earlier, we've focused for many years on the income statement. But we're really ramping up the balance sheet. And I won't bore you with the details, but it's easier to get the balance sheet data than the income statement data. So we did the harder one first, but now we get to enjoy doing the easier one. And what this curve shows is for that, I don't know, whatever it is now, 130 or 40 clubs that we've gathered the data, and this is all types of clubs, 18-hole golf courses, 9-hole golf courses, yacht clubs, city clubs, etc. You can see that on paper, there's a number of clubs that are worth close to zero. They have no equity. In fact, there are some that are negative. They're not on this particular chart. And that goes all the way up to $160 million of equity. So essentially what this is it's how much the membership, either the members who have been at the club for a long period of time or who joined the club and paid an initiation fee, it's the amount of money that's come into the club from the members. Now, some of it, to be clear, could be as a result of operating surpluses over time, what might be referred to in the standard for-profit business world as retained earnings. That can be a portion, no question, but the vast majority of in clubs is through capital income, whether it was capital dues, capital assessments, or initiation fee income. So it's a pretty wide distribution. The 25th percentile is just about 5 million. The 50th is about 12 million. And the 75th is about 19 million. I'll give you an example of how important this is. I looked at there's three clubs I was at recently that have 36 holes. They all have 36 holes. And from being at the clubs, I recognized that they have very similar footprints, meaning their clubhouses are fairly similar in size. They have a big, what I'll call a relatively large aquatics program. They have a number of tennis courts, into the teens. They have large parking lots, lots of parking, large driving ranges, 36 holes of golf, cart barns, maintenance, golf course maintenance, buildings, etc. So the footprint is very similar at the three clubs. But the net equity or unrestricted net assets of the book value of Club A is $34 million. Club B, it's $11 million. And Club C, it's $3.5 million. So the same footprint, but the equity in the club goes from 3 to 11 to 33 or 4 million. Vastly different. And as we move on, I'm going to ask a question, which would be pretty easy to answer, I think, but I'll throw it out there now for consideration while we move forward. Which of those 3 clubs do you think looks bright and shiny and new? And which of those 3 clubs do you think looks a little bit worn, not even a little bit, pretty worn out and not so bright and shiny and new? We've gathered so that's one metric, is how much is your club worth? By the way, this metric, this KPI, I actually meant to say at the beginning of the webinar, and you could maybe still do it if you happen to be in an office where you have your balance sheet and your income statement from your last fiscal year, because these numbers can literally come right off of a balance sheet. It takes no time to gather them. And with the fact that we've gathered this data now, and you get to see the distribution of the industry, it'll give you a sense of how your own club stacks up in relation to norms. There's a whole bunch more I could talk about there, of course, but we're going to take each of these, kind of a rapid manner here. Now, that's net worth at a point in time. That's the most recent fiscal year end. But more important, or equally important, is what's happened to that net worth over time. Any business, what would we want the net worth of the business to do over time? Do we want it to increase, remain flat, or decrease? If you were a business owner and you look at the book value, the value on paper of your business, obviously we want it to increase over time. There's no question. There's a question as to how much it needs to increase. So in a club, we believe that a club needs to increase its net worth at an average annual rate of around 3.5% at the least. Construction inflation over a 10-year period, we're looking at the net worth here of over 200 clubs since 2000, somewhere between 2005 and 6. Of these 200 clubs, the 61% of the clubs are not keeping, the net worth is not increasing at the rate of inflation. So 2/3 of the clubs, their net worth is going, their real value, the real value of the club is going down over time. That's a problem. A club that we've worked closely with that allows us to use their data openly is Carmel Country Club in Charlotte, North Carolina. There's an arrow pointing at what this chart shows is the indexed growth in net worth for those 200 plus clubs over a 10 or 12 year period. I had a theory when we started this analysis, was that Carmel would be one of the higher growth, higher clubs in terms of growth of net worth over time. They've grown theirs at an average annual rate of 9%. And now that we have over 200 clubs that have submitted this data over time, they're still 5th or 6th out of the 200. So they are, the thesis was correct, and they are a best-in-class club without question. And the reason for that is they've invested aggressively over that period of time, and they've invested in the right amenities and facilities to drive a demand in membership such that their initiation fee has been increasing consistently. The number of people joining every year has been increasing consistently, and they've really got the ball rolling in the right direction. And as such, the equity that's available to the club, or the equity that comes into the club from those sources I just cited, is growing, and it's growing at a more rapid rate than, much more rapid rate, 3 times the rate that we believe is necessary of inflation. So they have kind of got the ball into the court where their strategic issue now is not generating capital, it's determining what to invest the capital in. Very nice place to be. Okay, next metric is the net worth to assets. So one of the things that's important to realize is when you look at the balance sheet of clubs, 80% of the assets in a club end up as the depreciated value of property, plant, and equipment. So when you look at your balance sheet, if you have it in front of you, you'll see property, plant, and equipment at cost, or it might say gross property, plant, and equipment. The next line will say accumulated depreciation. That's the total depreciation of all that equipment over time. In the final line, it's a triumvirate, we'll say net property, plant, and equipment. So that's the current book value on paper of your physical property, plant, and equipment. In the industry, that number, whatever that number is in your balance sheet, you can check it now, is typically 80% of the total assets the club has. So assets are what the club has. It's what we own. It's the thing that endures over time. It's the thing that the members have contributed to build through equity investment, as I said earlier, capital investment, I should say, whether it's initiation fees or capital dues or assessments. 80% of that ends up in property, plant, and equipment. So what we do is we look at how much of the assets came from members versus others. So the net worth to assets ratio reflects how much came from members versus how much came from debt. The median for the industry is 70%, as you see here. I drew a line right in the center. When you look to the left of that line, those are clubs where the members aren't contributing enough. And on the right side of that line, that's where members are contributing more than the norm to the club. And so ultimately, we're looking at how much of the property, plant, and equipment that a club has been paid by the membership versus, debt from either member liabilities if you have refundable equity in your club, or from banks if you use banks for investing. And then finally, on the balance sheet, the next most critical metric, and this one is a beauty. It's a really easy metric to measure, and it provides incredible insight. And here you have the data from 130 or 40 clubs. So we'll get more, but this is a pretty good starting point. What we do is we look at the ratio of that net property, plant, and equipment, so the depreciated value, the paper value of your physical assets, as a percentage of the original cost of procuring them. If you take two clubs 10 miles away from each other, one is brand new, it costs $10 million to build, and they just opened the door, they're going to show gross property, plant, and equipment of $10 million, accumulated depreciation 0, and net property, plant, and equipment is $10 million. So they're going to have a 100% ratio of net to gross. If you'll go down the street and there's a club that was built 50 years ago, and they haven't kept up with it, and it was built, let's say, for $1 million 50 years ago, and it's fully depreciated, and they haven't done anything to it, it's got $1 million of gross PP&E, it's got $1 million of accumulated depreciation, and it's got net PP&E of 0, and that will be a club with a 0% ratio. So between 0 and 100% is, on one end, completely dilapidated and old, and on the other end, completely new and shiny. And if you look at the distribution of these 130 or 40 clubs, you can see the ratio goes from about 15% to about 70%. And the median is 49, which is very rational and logical. It says that we've about half depreciated everything that we have. Interesting. The lower this ratio, so if you do your calculation, if you have your balance sheet in front of you, you can do it while I'm talking. It takes 10 seconds. If you're on the lower side of this median, as the ratio moves to the left, your physical assets, your physical plant, your facilities look more worn down. As it moves to the right, they're more and more up to date. So I now look at this ratio before I go to a club and can easily predict what I'm going to see, and it's right on the money. It's on the money every time. I go into a club that's 24%, it's going to be beat up. I go into one that's 73%, it's going to be beautiful, and it works out that way. This is a ratio. So the 4 ratios I've just gone through on the balance sheet are critical, and they're the easiest ratios to calculate. You can calculate all 4 of them in 5 minutes. Now, the bridge between the balance sheet and the income statements is net available capital. We've talked about this in previous webinars. This is not a new ratio to our faithful listeners, participants. We believe that net available capital, which again is earnings before depreciation after covering interest on debt, it has to be at least 12 to 15% of the operating revenue. Half the clubs in the country have not kept up with that over time. And the clubs that are in the lower quartile, we refer to as capital rich. The clubs that are in the upper quartile, we refer to, I'm sorry, the lower quartile are capital starved, and the upper quartile are capital rich. And if you go back to that net worth over time metric, or the net PP&E to gross PP&E ratios, the clubs on the left are going to be the ones with declining net worth over time and lower net PP&E ratios, and the clubs on the right are going to be the opposite. They're going to have increasing net worth and more shiny and up-to-date and newer facilities. Now, this isn't just theoretical. I'm just going to take a quick side juncture here. I'm hearing myself throw numbers out. I don't want to sound like a machine. But these are ratios that give insight. These all relate. Everything I'm talking about relates to insight. And if you're in a board, or if you're in a boardroom of a club, you're the general manager or the chief financial staff member, and you're sitting in the boardroom discussing the cost of food, when you get a 22% net PP&E to gross PP&E ratio and no one even knows it, you're having the wrong dialogue. So these data points aren't there for theory, they're there for practice. And without having the viewpoint or the benchmark relative to the industry norms, if you only had your own club and you couldn't look at any other clubs, we wouldn't know what good or bad was. But with the benchmark, with the whole industry, or 1,000 clubs worth of the industry in front of us, we can very quickly discern what works and what doesn't. And so the point is, the ratio is there to change the dialogue. We shouldn't be talking about the cost of food in a club where the net worth is decreasing at double-digit rates over time, because it has nothing to do with the net worth. It's only affected by capital income. And this ratio here is the way that we put the capital income or the capital generation issue on the table with the board and the finance committee and, frankly, the membership, such that we can all get aligned on where we are as a club. The ratios will help the dialogue. I've seen it time and again. It will change the dialogue. Okay, we're moving to the income statement. You've seen this. All we look at is the proportionate share of fixed expense by club. Now, I'm not going to read every chart. You can see that what we've tried to do for those participating is we obviously have clubs that don't have golf and clubs that do have golf. Our database is 80-20, 80% clubs with golf, 20% clubs without golf. The proportion of fixed expenses by department is a very important measure for a couple of reasons. I want to focus on two things. One is the yellow pie slice, and one is the proportion of the fixed expenses that are overhead. So the yellow pie slice, which represents sports and amenities, spa, fitness, wellness, tennis, rackets, aquatics, etc., rock climbing walls in some clubs, shooting in some clubs. We've seen all sorts of varieties, paddleball, pickleball, etc. The data that what we've learned over time now, the key issue here is there's no question that the more a club spends on a broader array of amenities, the healthier the club is financially. The more members it has, the more capital it has, the higher initiation fee it has. And the reason for that is clear and simple. The data proves common sense, although in some quarters, this message isn't met with open arms. And I'll call that the golf-centric member or the golf-centric world. People might not want to hear this, but it's common sense that the broader the amenities existing in a club, the broader the prospective member demand. If you have more to offer, more people will be interested in joining. If you have less to offer, let's say golf only or yachting only, the only folks that want to join are people who golf or yacht. And there's a profound message in there. So simple a message, so powerful in terms of governance in clubs. And this same pattern holds true. Clubs that have a narrow yellow slice have a net worth that isn't growing as it needs to be to keep up with the future capital. The other point on the fixed expense metric, or KPI, is to be wary of What proportion of your fixed expenses are going into what we'll call overhead, G&A, buildings, maintenance and operation, and fixed charges versus services and amenities for members? Ideally, the average club, it's 50-50, 50% services, amenity, 50% overhead. This is clubs with golf. In some clubs, like the club on the right, you can see the proportion in the bottom half, which is services and amenities, as opposed to being 50%, it's 33%. So the club is fixed expenses are biased away from services and amenity for members and into overhead. In the club on the left, it's the exact opposite. Their money is biased towards services and amenities for members and less into overhead. So that's a critical metric, a critical KPI. It really does answer the question, where's the money going in terms of what members are paying for dues. As you've seen, if you've been on these webinars, another critical metric, so I'm working my way down from most important, is the dues ratio on the operating ledger. So that's your total membership dues as a percentage of your total operating revenue. Clubs with a lower dues ratio, that's backwards. Clubs with a lower dues ratio, I'll fix the slides, tend to have operating deficits, and clubs with a higher dues ratio tend to have operating surpluses. It's a critical point. The dues ratio takes 1 minute to calculate from your own financials. And if you look at that over time, this is what we want to do with a few of these metrics. We want to look at it over time. It's amazing how consistent it is. So it's for the last, 6 years, it's been at 50%. It's within a half a percentage point of 50. If you round up, it's 50%. The first 2 years, 2010 and 11, maybe because we started up our company and we probably had larger clubs as a proportion of all clubs in the first couple of years, it was about 51%. It's not greatly different. The ratio is consistent. It will be consistent, I believe, forever. And it's 50% at the median. So the question is my club or your club below or above that norm? If it's above the norm, you're likely to have strong operating results. As it gets lower and lower below the norm, you're likely to have weak operating results, meaning you're burning operating money. You have an operating deficit. The payroll ratio, another critical key KPI, and to be clear, it's all salaries and wages for everyone and all payroll taxes and benefits for everyone in the club, divided by the operating revenue. The median, 55% in clubs without golf, a little bit lower in clubs with golf, 55%, a little bit lower in clubs without golf. Same pattern. Clubs that have a high payroll ratio suffer with deficits. Clubs with a low ratio enjoy surpluses. Very critical. Everyone should know the ratio right off the top of their head. It's an easy ratio to calculate. It's an easy ratio to understand when you're budgeting or when you're looking down the road 10 years or down in the past 10 years. Over time, look at how consistent this is now that we have data for such a long period of time. At the median, in clubs with golf, to be clear, you can see the ratio floats right in the 55%. It's every single one of those is 55. It's just a matter of what the 1/10 of a percentage point is. So the 55% median, solid as a rock. And then finally, we can't help ourselves. It is a KPI. We know too many people in clubs want to discuss food and beverage, but what we do now, we're actually changing it. Instead of looking at it in relation to gross profit, we're actually looking at the profit or loss in F&B in relation to the total dues revenue. So in effect, in clubs that have a deficit, which is 3/4 of the clubs in the country in F&B, we're looking at what proportion of the dues revenue is going to subsidize the deficit. The median in clubs with golf is 6, and the median in clubs without golf is 3. The point, though, is that clubs that subsidize F&B more, as you see here, have much higher initiation fees than clubs that actually make a profit in F&B. I believe there's a cause and effect there. It's hard to prove, but I think the clubs that make a profit in F&B, for the most part, there are anomalies, make a profit in F&B because that's the dialogue in the club's boardroom. I've been in these clubs. They want to make a profit in F&B. They think that's a strategic issue. They don't focus on capital. They don't focus on the balance sheet. They don't focus on initiation fees and value proposition to have members join and drive the initiation fee up. And therefore, they have less demand for their club, and they have a lower initiation fee. Those that subsidize F&B the most probably reflect clubs in the industry that understand you need to treat amenities the right way. You need to have a broad set of amenities. You need to have a nice set of amenities, always improving to stimulate demand for membership in the club. And the more demand for membership in a club, the higher the initiation fee will be. It's the law of supply and demand. You can't get a better marker for that in a club than the initiation fee. And over time, it's only changed slightly, but what we've seen is this metric, the subsidies that are going to F&B are getting a little bit higher over time. Now, Russ Condi, and I agree with him, posits the theory that it might be indicative of clubs getting a little healthier after the meltdown. So during the meltdown and post-meltdown, everyone was focused on expenses. Cut. Food and beverage is the first place. And it's relaxed a little bit over the last 7 years, as you see here. But it's really only on the margin. We're talking about -4 to -6%. Now, it's a 50% change. But in terms of absolute dollars, it's not a big number, as you can see. We're talking about 4, 5, or 6% of the dues revenue. So we haven't done this webinar before. It's supposed to be 45 minutes. It's 49. I'm going to ask for questions before I summarize and conclude, but I hope there's some questions out there, please.
Actually, we don't have a lot of questions. Someone made the statement that cash flow is the critical statement of the 3 statements.
Well, I think cash flow is critical. When I think of cash flow, we could think of it in 2 ways: as the standard definition of cash flow, meaning where is it coming from, kind of where's it going. If you look at a cash flow statement looking forward, if you're in a healthy club, you're probably not worried about cash flows in the tactical sense. But if the questioner is asking in terms of cash flow related to cash generated before depreciation expense, I understand that, and that makes sense. But the key there is you need to, the only way you can increase the net worth for the most part in a club, the vast majority of clubs set their operating ledger to break even. So if that's the case, and we know from asking the question, 82% of clubs have said they do that, 18% fund depreciation. So for 82% of clubs that set their operating ledger to break even, the only way you can increase net worth in those clubs is if you have cash generation, earnings before depreciation, that's greater than the depreciation expense. If it's less than the depreciation expense, your net worth will decline. And if it's greater, it will increase. So if the question is related to that sense, it's true. It's very important. But you have to make sure you're generating enough cash every year, every month, etc., to overcome your depreciation expense. And if you're not, by definition, you're going backwards, and you're not going to have enough capital in the future to replace those assets that are being depreciated, which is part and parcel. It's pretty much the reason we started to look at the balance sheet with such intensity.
Okay, here's a good question. How does the typical board react to these concepts when you present them?
I can say, as we said, I've been in front of boards now for 8 years, I guess, 7, 8 years. The whole balance sheet and net worth dialogue hits people over the head like a ton of bricks. It's a tangible reaction. I know we're onto something. Honestly, I think it's the thing. This whole dialogue is going to change. And there's, from analyzing the data, I believe 25% of the clubs in this country are in severe financial distress. and they're the ones that are capital starved. They're the ones that have cut the initiation fee to zero or to low numbers. They're not generating the capital necessary to overcome the depreciation expense. Their physical plant and property is depleting right in front of their eyes. And the next recession, which we know is in front of us, we haven't had one now in 8 years, it's got to be coming at some point, is going to I think it's going to knock a bunch of those clubs out of business, unfortunately. I think the economic meltdown was the left jab. It staggered those clubs. They're reeling. The measures that prove they're reeling are the ones that we just mentioned: net worth over time, net PP&E to gross PP&E, capital generation, net available capital ratios. They all point to difficulty. The next recession is going to be the right hook. It's what puts them on the canvas. So this is critical stuff, but there's time while people are still, it's not been huge growth in the economy, but while people have, let's say, some optimism, we need to ask our members in our clubs to contribute to capital in a manner necessary or commensurate with the capital needs of the club. We have to do it. Now is the time. So this dialogue helps to focus the board on that critical issue. It's the critical issue, and it keeps them out of the darn weeds, managing departments or talking about the cost of food or cost of beverage in the boardroom. It really works. I've seen it. It's incredible what it does.
We have a few more questions coming in. Someone asks, for the dues as a percentage of operating revenue calculation, do you include capital dues?
No, that's on the capital ledger. That's just the operating dues as a percentage of the operating revenue. The capital income is off on the capital ledger. Good question.
Is it possible to calculate food wage cost and beverage wage cost separately, or is this even helpful?
It is absolutely, in my opinion, it depends on why you're doing that. If that's the food and beverage manager trying to figure that out, that's great. If it's the board asking that, it's a bad sign. That has nothing to do with the board or in the boardroom. So it depends on why you would calculate that. There are clubs that do it. There's no question, number of clubs. I would say probably Jim Boyle could answer it, and Kevin Shea could answer it precisely, but my guess is the vast majority of clubs track beverage labor and food labor and wait staff and kitchen staff separately. But it has no place in the club boardroom. It doesn't even have a place in the club committee room. It doesn't have anything to do with strategic governance. If the F&B manager is trying to figure it out, that's great, but leave it there.
Where do most clubs include mandatory service charge? In F&B revenues?
In our financial insight model, we put all of the service charge, whether it's through level service fee or house charges, or whether it's through a per chick gratuity, all of that is considered F&B revenue.
Okay, is paid health insurance benefits included in the calculation of the labor ratio?
Absolutely.
Did you say 80% fund depreciation, and please define your interpretation of funded depreciation?
No, I hope I didn't say that. What we've asked clubs is, do you fund depreciation? And the answer to that is 18% said yes, 82% said no. And funding depreciation means when you set your operating dues, so we're on the operating ledger, it's really a mingling. The way I think of it is it's a mingling of the capital and operating ledgers. I'm not a fan of it, frankly, but it's good. It makes sense. If you can do it, that's great. But it's when you set your operating dues such that the operating result will generate an amount of cash that equals the depreciation expense, and then that cash is available for repair and replacement of physical assets. It's a very technical or esoteric thing. I just think it's nice. It's sometimes if clubs do that, it's just one number. You look at your dues, it's $800 a month. It includes the capital. I'm a believer you want to say $700 a month for operating, $100 a month for capital. I think members need to understand in clubs that they have to fund two things. They have to fund the operation of the club day to day and year to year, but they also have to fund the capital needs over time. And the members ultimately are responsible for both of those things. I just like breaking it apart.
Okay, please discuss the percentage of annual capital needs that should be sourced from existing members versus initiation fees.
That's a great question. And I actually have to apologize because I ran out of time with my flight preparing for the webinar. I actually was going to try to show that as one of our KPIs. It's something that we're keenly interested in. I'll say this. The healthier a club is, as a reflection of a broader set and a broader set of amenities and services coupled with fresher and more up-to-date plant and equipment. So a club that has a high net PP&E to gross PP&E ratio, a club that has a high net available capital ratio, a club that shows its net worth increasing at rates, let's say 6% or north over time, over those 10 years. If you look at those clubs, they generate a much higher proportion of their capital needs from initiation fee income because they have a value proposition that's compelling enough that prospective members are willing to pay to get in, and therefore they're contributing. Ultimately, what's happening is they're contributing into the equation an amount of capital that's commensurate with the capital that members that are there prior have contributed. If you take the flip of that, the clubs that have a net worth declining over time, the clubs that have a low net available capital ratio, and the clubs that have a low net PP&E to gross PP&E ratio are the clubs where they don't generate a substantive portion of their capital needs from initiation fee income, because they have low or no initiation fee income, which by definition means that the burden of the capital needs falls on the current members, even though they've contributed in the past. So they can't get the incoming member to contribute because there's less there to contribute to begin with. It's a critical, it's a great question. It's a critical issue. And boy, if you have a board thinking like that and talking about that instead of cost of food, where do you think the club's going to be 5 or 10 years from now?
Okay, and we have a few people have asked if we're going to send this out. We're recording, and we'll send a link to the recording after the webinar. We have so many questions that I think a few of them we're going to have to do by email offline, but I'm going to give you one more. What percentage of clubs are showing a dues bucket and a capital bucket separate so that capital, net available capital monies don't get left on just to cover operating losses?
Well, that's a very good question as well. In our financial insight model, we do segregate the two distinctly. Now, I showed the model earlier in the webinar, and I did say they intersect based on the surplus or loss. The way that we look at it based on the data, and this is from 1,000 clubs, I believe this is very accurate. Half of the clubs, their operating result is hovering right around break even. It's, you know, there is a club always in the database. The median is right at 0%. So there's a club that's right around, you know, that they're literally at $0 on the operating ledger at the end of the year. But half of the clubs are somewhere between plus 3% and minus 3%, meaning operating margin, meaning the absolute dollars made or lost on the operating ledger is less than 3% of the overall revenue. So for the sake of discussion, I consider that break even because you're never going to be exactly at zero one way or the other. So half the clubs will say don't intermingle the capital and operating buckets in any way because they're at operating break even. So the capital stands on its own and the operating stands on its own. A quarter of the clubs where that operating deficit is greater than 3% of the revenue, those are clubs you start to see with there's substantive operating deficits, and those substantive deficits, to the questioner's point, are consuming capital, and that's a problem. And then you got another quarter of the clubs where the operating surplus is greater than 3%, And I'd say generally there's two reasons for that. One is the 18% of clubs that fund depreciation. So that's, let's just call it, 3/4 of that bucket. So they're doing it intentionally. They're intermingling those ledgers intentionally, and kudos to them that they can, and they do. And then the other group of clubs in there tend to be larger clubs. When you get into the $10 million plus clubs, you begin to see some on the margin economies of scale, and those clubs start to generate some operating surpluses, not because they really intended to, but just because they can as a result of their size and their momentum, and that money ends up in their capital bucket as well. So half the clubs do not intermingle. A quarter are consuming capital to subsidize operating deficits. Those are the clubs in trouble. And a quarter tend to generate surpluses that are having some kind of an impact favorably on the capital bucket.
Okay, last one for today. What % of clubs do not put the value of a physical plant on the balance sheet?
I think I'd have to say 0%. I think everyone has to put that on their balance sheet. Everyone has to account for their physical property. Now, I have seen one club, one out of 1,000, where they do some weird stuff and they actually expense their capital. They don't depreciate it, which I don't, but that's an anomaly. So every club, ultimately, I'd be shocked if there's a club where you can't look at the balance sheet and see what the gross property, plant, and equipment, meaning at cost, what it was paid for when it was acquired, the accumulated depreciation, and the net PP&E after depreciation.
So to the rest of the questioners, we're going to respond to those by email, and we will get back to you as quickly as we can on those. I have to thank you that we had nearly 150 people stay on with us for the entire session.
Well, thank you, everyone. Maybe we won't talk before Thanksgiving, but happy Thanksgiving and holidays to everyone. And we're here to help if we can in any way. Thank you very much.